Imagine finding out that the person managing your life savings gets a secret cut of your money every single month, and it's completely legal.
Yeah, that's a tough pill to swallow for a lot of people.
Right. You sit across the desk from them, you're reviewing this polished PDF report, and they point to a specific mutual fund, assuring you it's the absolute best fit for your retirement. And you just assume they are making that recommendation based purely on financial data.
Which is what you want to believe, yeah.
Exactly. But what if there's this hidden current of money, like a perk or a commission or an insider benefit that is quietly tipping the scales?
Well, it's what economists call the principal agent problem. You are the principal trying to grow your wealth, right? And the financial professional is the agent managing it for you. Ideally, your goals are perfectly aligned.
Ideally, yeah.
But when third parties start offering the agent financial incentives to recommend their specific products, those goals can very quickly diverge.
I can imagine.
And in the financial sector, influence rarely looks like, a cartoonish briefcase full of cash. It's woven directly into the daily mechanics of how financial products operate.
Which brings us to the core of today's deep dive. We are looking at the hidden world of inducements.
Right. That's the industry term for these perks and commissions.
Inducements. And we are cutting through the dense legal jargon of Luxembourg private banking and the broader European frameworks, specifically MiFID II, to understand how regulators try to control this invisible flow of money.
It's a massive regulatory effort.
And we're keeping a close eye on the highly specific Luxembourg regulations, too, primarily a foundational text from 1993 regulating the financial sector.
Yeah, the law 5 April 1993.
Right. So our goal today is to figure out what these inducements actually are, when an advisor is legally allowed to take them, and to expose a massive misconception about financial transparency that constantly trips up even the most seasoned banking professionals.
Yeah, it really does. To start, we have to look at how incredibly broad the regulatory net is cast.
Okay, how broad are we talking?
Very broad. When the law talks about an inducement, we are moving far beyond the idea of an upfront cash bribe. The legal framework covers virtually any fee, commission, or benefit that is linked to an investment service.
Wait, like any benefit, so it doesn't even have to be a direct monetary payment?
No, not at all.
What else could it be then?
It can absolutely be non-monetary. Direct fee rebates and cash commissions are the most obvious examples, sure, but the umbrella is much larger.
Like what? Give me an example.
Think about specialized training seminars provided by a fund manager to a bank staff.
Oh, interesting.
Or think about sophisticated, really expensive market analysis software provided for free by a third party. Even premium access to corporate management teams.
Wow, okay.
Essentially, if a third party gives a financial service provider something of value that is connected to the service they provide you, the client, that is an inducement.
I see how software or training could influence an advisor. But looking through our sources, there is one specific mechanism that seems to dominate the landscape of private banking and investment advice.
Oh, yes. The trailer fee.
Right. It's called a trailer fee, or in Luxembourg, a retrocession de commission. How exactly does that work?
So the trailer fee is arguably the most common everyday example of an inducement. It is a recurring commission paid by a third party.
Like the creator of a financial product.
Exactly. Usually the creator of the product, like a mutual fund manager, they pay it to the bank or the advisor who distributed that product to the end client.
The word trailer makes it sound like it's dragging behind something. Is that the right way to think about it?
It is the perfect visual. It literally trails the client's investment over time.
Oh, wow.
Yeah, it's not just a single isolated payment made on the day you sign the subscription paperwork.
So it keeps going.
Right. For as long as you remain invested in that specific product, a percentage of the management fee is continuously routed back from the product provider to the intermediary.
To compensate them.
Exactly. It compensates them for ongoing distribution, maintaining custody of the assets, or providing continuous servicing of the account.
Okay, let's ground this. A trailer fee isn't like a car salesperson getting a one-time bonus for selling you a sedan.
Right.
It's more like that salesperson getting a tiny ongoing cut of your gas money every single month for the entire decade you drive that car.
That is a great analogy. Because it captures the duration, and the recurring nature of the mechanism. The longer you hold the investment, the more that ongoing relationship is remunerated.
Hold on, though.
Yeah.
If they are legally required to act in my best interest, How is that not a massive, undeniable conflict of interest?
That is the big question.
I mean, if my advisor knows they are going to get a slice of my gas money for the next 10 years if they put me in Fund A,
Right.
but they get absolutely zero ongoing cut if they put me in Fund B, why wouldn't they just constantly push Fund A?
Exactly.
Why is this practice allowed to exist at all?
Well, that is exactly the tension regulators wrestle with. And the answer is that it is not always allowed. Regulators didn't just shrug and let the industry do whatever it wants.
Okay, good.
Under the Luxembourg legal framework, specifically Articles 37-33B and 37-33C, the legality of these fees depends entirely on how the service is classified.
Oh, I see.
Yeah, they draw distinct, unforgiving red lines based on the type of relationship you have with your professional.
So the rules change depending on what I am specifically paying the bank to do.
Yes. Let's look at the two services where the law builds an absolute fortress around your money.
Which are?
Independent investment advice and portfolio management. If a professional is providing either of these two services, the regulatory framework draws a hard line.
Correct.
They are entirely prohibited from accepting and retaining third-party fees, commissions, and benefits.
Completely banned, like zero wiggle room.
Basically none. I mean, save for some incredibly minor, strictly defined non-monetary things.
Like what?
Think along the lines of a basic market commentary report or a branded pen.
Right. A pen isn't going to sway $1 million investment.
Exactly. But anything substantial, and certainly anything like a recurring monetary trailer fee, is strictly and entirely prohibited.
Let's break those two categories down.
Yeah.
What does portfolio management actually mean in this context?
Portfolio management is a discretionary service. It means you hand over the keys.
Okay.
You sign a mandate giving the manager the authority to make buy and sell decisions on your behalf without asking your permission for every single trade.
So they have total control.
Right. And
Yeah.
because you are giving them total discretion over your wealth, the law mandates absolute alignment. They cannot be swayed by a third party offering a kickback because you aren't there to double-check their math on every trade.
That makes total sense. If I'm paying them to drive the car, they shouldn't be taking bribes from the gas station.
Exactly.
What about independent investment advice? How is that different from regular advice?
When an advisor claims to be independent, they are legally committing to assessing a sufficiently diverse range of financial instruments available across the entire market.
So not just their own stuff.
Right. Not just their own bank's in-house funds or products from entities they have close links with. If you are claiming to offer truly independent, objective advice, your compensation structurally cannot be dependent on which specific product you recommend.
Okay, so if I have a discretionary portfolio management account or an independent advisor, I am walled off from these trailer fees.
Yes, you are.
But what if I'm listening to this right now and I just have a standard brokerage account? Or, I get non-independent advice from my local retail bank.
That's a different story.
Are they just operating in the Wild West, or they could take whatever trailer fees they want?
It is not the Wild West, but the rules do change dramatically. For all other investment services that fall outside of that strict ban, we transition to the core framework governing when an inducement can be accepted. And that brings us to the famous Article 37-3 of the Luxembourg Financial Sector Law.
Article 37-3.
Got it. Yeah, think of it as a highly regimented obstacle course. The bank cannot simply accept the money. They have to clear 3 strict hurdles.
An obstacle course. I like that. Walk me through the hurdles. What does a bank have to prove to legally keep that ongoing cut of my investment?
The first hurdle is the most substantive. The benefit must actively enhance the quality of the service provided to the client.
Actively enhance it. Okay.
The second hurdle is a protective one. The benefit must not impair compliance with the professional's duty to act honestly, fairly, and professionally in the best interest of the client.
So it has to actively make things better for me, and it can't harm my underlying interests.
Right.
What's the third?
The third is disclosure, but it cannot be just a passing mention buried in a footnote.
Obviously not.
The law requires comprehensive, accurate, and understandable disclosure regarding the existence, the nature, and the amount of the payment.
And what if they don't know the exact amount yet?
If an exact monetary amount can't be calculated up front, they must disclose the exact method they will use to calculate it. And crucially, this disclosure must be provided before the investment service is rendered.
Before we dig into how that obstacle course actually works in practice, I noticed our sources mention a newer piece of legislation.
Oh, right.
Yeah, a commission-delegated directive from February 2026. Does that rewrite the rules we just talked about?
It's an important regulatory update, but we need to keep it in its proper context. That 2026 directive specifically amended the rules concerning how third-party execution and research services are handled. So it tweaks the regime for those highly specific institutional-level interactions. However, our sources are crystal clear on this. This new development does not displace the general inducement test.
Oh, good to know.
Yeah, the three-part obstacle course remains the supreme standard for general inducements in Luxembourg private banking.
Awesome. Because I really want to look closely at that first hurdle, proving that a third-party payment or perk enhances the quality of service.
It's a tricky one.
Right. Proving an upfront fee was disclosed is easy. You have a signed piece of paper. But how does a bank objectively prove that a third-party software tool genuinely enhances service quality without impairing the client's interest?
It's hard.
That sounds like a blank check for creative writing by the compliance department.
It can be, which is why regulators audit these justifications so rigorously. The compliance departments really sweat over this.
I bet.
Let's say a major mutual fund offers to pay for a bank's expensive market analysis software. Let's call it a high-end data terminal.
Okay.
The bank's compliance officer cannot just write a vague memo saying, this tool helps us understand the market better, therefore the client benefits. That fails the test entirely.
Wait, why does that fail? If the bank understands the market better, don't I get better advice?
Because the enhancement has to be directly linked to the specific service provided to the client.
Okay.
And it cannot merely be a substitute for something the bank should be paying for themselves as a standard cost of doing business.
Oh, that makes sense.
Yeah, if the free software just saves the bank money and inflates their profit margins without offering a tangible proportional upgrade to your specific portfolio outcomes, it is not a valid inducement.
Wow.
They have to document a concrete causal link showing how that specific perk trickles down to benefit you.
And if they can't establish that concrete link, does the signed disclosure form save them?
Absolutely not. And that brings us to what is perhaps the most crucial takeaway from our entire analysis today.
Let's hear it.
It is a massive pitfall in the industry, something that trips up professionals constantly. We can call it the transparency trap.
The transparency trap. What exactly are they getting wrong?
There is a deeply ingrained belief in many financial circles that transparency equals compliance.
Oh, interesting.
For decades, the cultural emphasis in finance has been on disclosure. You know, getting everything out in the open, making sure the client signs off on the risks and the fees.
Just sign on the dotted line.
Exactly. Because of that legacy, many practitioners wrongly assume that as long as they proactively inform the client about the trailer fee or the perk, the inducement automatically becomes legally admissible.
Because they think, hey, I was honest. I didn't hide it. The client signed the 40-page document acknowledging the ongoing fee structure, so we are completely in the clear.
Exactly. But under this legal framework, informing the client is necessary, but it is wholly insufficient.
Insufficient.
Right. An inducement is not magically sanitized just because it has been disclosed. It must also satisfy those substantive conditions we just discussed.
The actively enhancing the service quality and protecting your best interests.
Yes. If those first two hurdles aren't cleared, the inducement is invalid, period.
It's like a doctor handing you a waiver that says, I am receiving a financial kickback from a pharmaceutical company for prescribing you this specific blood pressure pill.
Yeah, that's exactly it.
Just because the doctor was entirely transparent and disclosed the kickback doesn't mean it's actually the safest or most effective pill for your heart condition.
That is a brilliant way to frame it. Because in medicine, just like in finance, there is a massive asymmetry of information.
For sure.
You rely on the professional's specialized expertise to navigate a highly complex system. If that expertise is compromised by a background financial incentive, a piece of paper disclosing the incentive doesn't magically cure the underlying conflict of interest.
A piece of paper isn't a cure. I like that.
Right. The regulator wants substantive protection for the client, not just procedural paperwork. Treating mere disclosure as a free pass is a fundamental misunderstanding of the law.
That is a huge paradigm shift for how we think about paperwork. Right. And for a lot of people listening, whether you're a retail investor or dealing with high net worth private banking, there is serious disclosure fatigue.
Oh, absolutely.
You get a massive booklet, you flip to the back, you sign it, and you assume your signature absolves the bank of the conflict.
Mm-hmm.
But these regulations are essentially saying, no, your signature does not wave a magic wand over a bad practice. The practice itself has to be objectively justified.
It forces the financial institution to look inward and do the hard work before they ever hand a form across the desk.
Yeah.
The compliance test isn't how do we draft a waiver for this conflict. The test is, May this benefit be legally accepted and retained in the first place.
It shifts the burden of proof entirely.
Exactly. The financial ecosystem must justify its compensation structures not just to the regulators, but implicitly through the actual value they provide to the end investor.
Which is exactly why understanding these mechanics matters to you, the listener. We've covered a lot of ground today, moving from the broad definition of inducements to the specific mechanics of ongoing trailer fees.
Yes, we have.
We learned that if you are paying for independent advice or discretionary portfolio management, the law builds a wall around your money, completely banning third-party perks to ensure your advisor's loyalties aren't divided.
And we established that for all other financial services, the industry must navigate a strict three-part obstacle course.
The famous hurdles.
Right. They must prove the fee enhances your service, doesn't harm your interests, and is clearly disclosed up front. Most importantly, we debunk the transparency trap.
Yes, simply telling a client about a conflict of interest does not resolve it.
Exactly.
This knowledge gives you tremendous leverage. The next time you sit down to review your portfolio, whether you are dealing with a private banker in Luxembourg or reviewing a standard retirement account, you are no longer just a passive receiver of dense fee schedules.
You know the rules of the game now.
You have the right to look at your financial professional and ask directly, how exactly does your background compensation, these trailer fees, actively enhance the service I am receiving?
That's a powerful question.
Because if they stumble over that answer, they might not be clearing those legal hurdles either.
It changes the dynamic entirely. You move from passively acknowledging a cost to actively interrogating its value.
Before we wrap up, I want to leave you with one final thought to ponder. A bigger picture question that builds on everything we've uncovered today about how money flows in the background. We know that trailer fees provide an ongoing stream of revenue for the people distributing financial products. So consider this. If a massive portion of the global financial ecosystem relies heavily on these invisible continuous currents of money just to keep their lights on and their profit margins high, how might that be subtly shaping the very types of financial products that are invented in the first place?
Oh, that's a great point.
Are the products heavily marketed to you actually the most innovative and efficient ways to grow your wealth? Or are they just the products expertly designed to pay the best ongoing rent to the distributors? Think about it.
A very critical question to keep in mind the next time you are handed a prospectus.
Absolutely. Thanks for joining us on this deep dive.